How Arthur Andersen destroyed itself in 90 days. Picture this. October 2001. Arthur Andersen, one of the legendary Big Five accounting firms, stood as a titan of American business with 85,000 employees across 84 countries and annual revenues exceeding $2 billion. For nearly 9 decades, the firm had built its reputation on uncompromising integrity, founded by Arthur Edward Andersen himself with the motto, "Think straight, talk straight." But in just 90 days, this empire would crumble faster than any corporate collapse in history. The catalyst wasn't a market crash or economic downturn. It was something far more damaging: the systematic destruction of evidence in what would become the largest audit failure in American history. One partner's decision to fire up the document shredders would trigger a chain reaction that obliterated not just a company, but an entire way of doing business on Wall Street. The trouble began years earlier, buried deep in the accounting books of Enron Corporation, Arthur Andersen's second-largest client. Since 1985, Andersen had served as Enron's auditor, collecting approximately $52 million annually in audit and consulting fees. This wasn't just any client relationship. It was a financial lifeline that represented nearly 10% of Andersen's Houston office revenue. But more importantly, it represented everything wrong with the accounting industry's dual role as both auditor and consultant. David Duncan, Andersen's lead partner on the Enron account, found himself in an impossible position. His job was to independently verify Enron's financial statements, but his paycheck depended on keeping Enron's executives happy. This fundamental conflict of interest created a culture where questioning the client meant questioning your own livelihood. Behind Enron's gleaming facade of innovation and growth lay a labyrinth of financial engineering so complex that even seasoned Wall Street analysts couldn't decode it. Special purpose entities, mark-to-market accounting, and off-balance sheet partnerships created an illusion of profitability while hiding billions in debt. Andersen's auditors weren't just aware of these practices, they were complicit in designing them. Internal Andersen documents later revealed that the firm's own risk management partners had flagged Enron as a maximum risk client as early as 1999. One internal memo stated bluntly that Enron was riding the ragged edge of acceptable accounting practices. Yet year after year, Andersen continued to sign off on Enron's financial statements, issuing clean audit opinions that gave investors and creditors false confidence in the energy giant's stability. The house of cards began tumbling on October 16, 2001, when Enron announced a $618 million third-quarter loss and a shocking $1.2 billion reduction in shareholder equity. The announcement sent Enron's stock price into freefall and triggered immediate scrutiny from the Securities and Exchange Commission. This is where Arthur Andersen made the decision that would seal its fate. On October 23, 2001, just 7 days after Enron's devastating announcement, David Duncan sent an urgent email to Andersen employees. It might be useful to consider reminding the engagement team of our documentation and retention policy. This seemingly innocuous message was actually a coded instruction to begin destroying documents. What followed was an orgy of evidence destruction that would shock even hardened federal prosecutors. The shredding operation at Andersen's Houston office ran around the clock for weeks. Employees worked in shifts, feeding thousands of documents into industrial shredders while others deleted computer files and emails. Nancy Temple, an Andersen lawyer in Chicago, coordinated the destruction from headquarters, ensuring that potentially damaging documents disappeared from offices across the country. The scope was breathtaking. Tens of thousands of emails deleted, entire boxes of documents shredded, and backup tapes destroyed. One Andersen employee later testified that the shredding was so intensive that the machines repeatedly broke down from overuse. Security guards reported seeing dumpsters filled with shredded paper being hauled away daily. The destruction continued right up until November 8, 2001, when the SEC formally ordered Andersen to preserve all Enron-related documents. By then, it was far too late. The irony was devastating. Arthur Andersen, a firm built on the principle of meticulous documentation and audit trails, had systematically destroyed the very records that could have provided its defense. When federal investigators arrived at Andersen's offices, they found gaps so obvious that prosecutors didn't need forensic experts to prove obstruction of justice. Missing email strings, incomplete file folders, and employees who suddenly couldn't remember crucial conversations painted a picture of deliberate concealment. The destruction was so thorough that investigators estimated only about 10% of the original Enron audit files remained intact. This wasn't sloppy document management. It was criminal obstruction on an unprecedented scale. As news of the document destruction leaked to the media in January 2002, Arthur Andersen's other clients began fleeing in panic. The firm's credibility, once considered unshakable, evaporated overnight. Major corporations couldn't risk association with an auditor under federal investigation for evidence tampering. Delta Airlines, FedEx, Merck, and dozens of other blue-chip companies terminated their relationships with Andersen, taking hundreds of millions in annual fees with them. The client exodus accelerated daily, creating a death spiral that no amount of damage control could stop. Internal Andersen documents revealed that the firm lost over 300 public company clients in just 6 weeks, representing more than half its annual revenue. Partners watched helplessly as decades of relationship building crumbled in a matter of days. The final blow came on March 14, 2002, when federal prosecutors in Houston announced criminal charges against Arthur Andersen LLP for obstruction of justice. The indictment was devastating in its simplicity. Andersen had knowingly, intentionally, and corruptly destroyed documents to impede federal investigators. The firm's 85,000 employees suddenly found themselves working for a criminal defendant. The psychological impact was immediate and brutal. Talented accountants and consultants began abandoning the firm en masse, joining competitors or starting their own practices. The brain drain accelerated the collapse as clients followed their former Andersen advisors to new firms. By April 2002, Andersen's workforce had shrunk to fewer than 30,000 employees, and the firm was hemorrhaging cash at an unsustainable rate. The trial that began in May 2002 was less a legal proceeding than a public autopsy of professional self-destruction. Prosecutors presented a timeline so damning that Andersen's defense team could only argue technical definitions of obstruction rather than deny the underlying facts. The government's star witness was David Duncan himself, who had agreed to cooperate in exchange for immunity. Duncan's testimony was devastating, describing in detail how senior Andersen partners had orchestrated the document destruction while fully aware that federal investigators were circling. He revealed that Nancy Temple had specifically instructed him to remove her name from certain documents and to ensure that smoking gun memos disappeared permanently. The jury heard recordings of frantic phone calls between Andersen partners as they coordinated the cover-up, their voices betraying full knowledge of the criminality of their actions. On June 15, 2002, exactly 8 months after the document shredding began, a federal jury convicted Arthur Andersen of obstruction of justice. The verdict was unanimous and swift. Jurors had deliberated for just 7 days before reaching their conclusion. The conviction triggered the firm's immediate death sentence. Federal law prohibited convicted felons from auditing public companies. Arthur Andersen, once the world's largest accounting firm, was officially out of business. The final tally was staggering. 85,000 jobs lost, billions in shareholder value destroyed, and an entire profession forever changed. Partners who had built careers spanning decades found themselves starting over with nothing but the clothes on their backs and tainted resumes. The firm's pension funds, depleted by legal fees and client defections, left thousands of retirees facing financial ruin. The Arthur Andersen collapse sent shockwaves far beyond the accounting profession. Congress responded with the Sarbanes-Oxley Act of 2002, the most sweeping corporate governance reform since the Securities Acts of the 1930s. The legislation banned accounting firms from providing certain consulting services to audit clients, created the Public Company Accounting Oversight Board to police auditors, and imposed harsh criminal penalties for securities fraud. The Big Five accounting firms became the Big Four overnight, creating an oligopoly that persists today. PricewaterhouseCoopers, Deloitte, Ernst & Young, and KPMG, absorbed Andersen's former clients and employees, but the profession's reputation took decades to recover. The firm that once embodied the highest standards of professional integrity became a cautionary tale taught in business schools worldwide, a reminder that no institution is too big or too established to destroy itself through criminal conduct. The ultimate tragedy of Arthur Andersen's demise lies not in its speed, but in its preventability. Had the firm simply preserved its documents and cooperated with investigators, it might have survived even the Enron scandal. Other accounting firms had weathered audit failures and regulatory sanctions, paying fines and implementing reforms while continuing operations. But the decision to obstruct justice transformed a civil matter into a criminal conspiracy, leaving prosecutors no choice but to seek the corporate death penalty. In trying to hide its mistakes, Arthur Andersen guaranteed its destruction. The firm that Arthur Edward Andersen built on the principle of thinking and talking straight died because its leaders chose to think crooked and talk in shredded documents. Today, a small rump entity bearing the Andersen name still exists solely to handle legal claims and wind down affairs, a ghost of corporate America's most spectacular self-immolation. The lesson remains stark and unforgiving. In the modern era of corporate accountability, the cover-up isn't just worse than the crime, it's corporate suicide.